Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
For us, this is myself, Sharma, and Marc. We're doing a new version of our Show Me the Money podcast, and we're doing these as a regular live feed now. So good to see you again, Marc. Looking forward to this.
Yes, it should be very good, and hopefully we'll be able to get to the bottom of answering all these questions that I know I get every day from property investors and developers.
Absolutely, and for myself as an investor and a developer, I've certainly got a few questions for you. So let's go straight into it. Obviously, myself as an investor and developer, Marc, you as the owner of Wharf Financial, all things to do with lending, a font of knowledge, indeed. So let's talk a little bit about what's been happening in the lending market. And I guess since we last did a recording, we've had a change in government, right? So first of all, what have been the effects of this new Labour government on the lending landscape and what you're seeing?
Well, I tend to try and keep away from the politics of it, and also I suppose, what people are talking about in the press, and try to concentrate on what's actually happening on the ground and what's happening in the day-to-day lending and property investment market. So what I'm seeing is just a lot of activity. People are wanting to really get on with property investment. Over the last few years, we saw people that were really reluctant, mainly because of the interest rates. But now that the base rate is starting to come down, people think it's a good time to actually make a move. And there is talk of capital gains tax increasing, but what we're seeing is a lot of activity, and all the brokers I speak to are saying the same. All the lenders are saying that they're seeing good amounts of volume coming in, and it's a good spread. Everything from people just buying single buy-to-let properties all the way through to people who are refurbing or doing development. So there is a real mixture, and we are seeing a lot of activity at the moment.
Right. Would you say it's any different to this type of applications you'd typically see before? I mean, I guess we're going to see changes in strategy for housing and meeting housing targets from the new government, and actually we might see interest in new types of products. We might see certain types of investors perhaps even exiting the market. I'm wondering what sort of opportunities that's presenting in terms of, what you might have seen more of that you might not have expected, or do you think it's a bit too early to say at this stage?
I think it is probably a bit too early, but we are seeing a bit more development than refurb, I think. Okay. Our numbers are suggesting that. So previously we were seeing a lot of people turning terrace houses into HMOs, and a lot of the Article 4s that have been put in place have sort of curtailed that a little bit. Yeah. So what we're actually seeing is a lot more ground up development. Only smaller stuff, but people are thinking that's where the value is, and that's where the opportunity is. So we're seeing a lot more small scale development as opposed to refurbs. So I think that's probably an interesting change to note.
That is interesting. I guess build costs have probably got something to do with that, because we've probably seen a little bit more stabilisation. Anecdotally, there's a lot more builders who are calling clients to see if they've got any jobs, which is obviously a good indication that actually pricing will be a bit more sensible now, because they need to go out and hunt for the work rather than being able to bat it off because they've got too much on their plates. That's probably one thing that's stimulating it, I imagine. It's a bit more affordable and there's a bit more certainty, but we still have planning challenges and things like that to get things over the line.
Yeah, exactly. It's the build costs we've seen stabilise a little bit, but we are still seeing people come to us and they've not actually got enough profit in the deal. So there are new people entering the market, and they don't necessarily understand that you need to have profit in a deal. You can't just be relying on the potential rental income. And also on top of that, we're seeing people who are saying, "Oh, we want an investment valuation," especially on the HMO stuff. That we want an investment valuation. We're expecting it to be this amount. The lenders aren't really doing investment valuations so much anymore. There's a couple out there, but they are reduced. They're not as high as you would be expecting. I think a few lenders have been burnt in the past, and they're moving away from the actual the investment side. So making sure the numbers are right and that you've actually got profit and that you're not going to be relying on a rental yield calculation to get to the GDV you need to get to is really important, because if you do that, you can get yourself in a bit of trouble when you go to refinance, and then most lenders are saying, "Oh, we're going to be using bricks and mortar," and it's actually worth 100 grand or whatever less than you're expecting. So making sure, we always say, make sure the exit is solid before you get involved in even the start of it. So
that's great advice, and that's something I always try and do as well. So if I've got a development deal, then I'm already looking at the term finance exit. What sort of lenders would like to lend on that sort of deal? Is it on lease? Is it not on a lease? What sort of valuation basis are they going to instruct to their surveyors, so that you kind of know what the appetite's going to be? And I try and work backwards from there. That's solid advice. Very interesting. So we've had some base rate movement as well, I guess, since the election. We obviously dropped down from 5.25 to 5 that was in July, right?
Yes.
And the last meeting, the last Monetary Policy Committee meeting, it was a hold, which I think we were all expecting. But what I think one thing that we've talked about before is that rates are obviously based on swap rates, and they've actually already factored in a lot of the macro environmental factors into their projections.
Exactly.
So actually, I don't think there's been any surprises. So what are we seeing in terms of actual lender rates at the moment? Where are you seeing those for the sort of the most popular products?
It's interesting what you're talking about, the swap rates and how lenders have already factored that in. We had a customer come to me, when was it? Yesterday. Sorry, all days seem to merge into one. A customer came to me yesterday, and they'd taken out 5-year fixes a year and a half ago, probably something like that, when rates were on the way up, probably at their sort of like highest level, really. And they were saying, is it worth us breaking, or is it worth staying in where we are? And it probably wasn't worth them breaking, but if it was, they were thinking, well, actually, should we be doing this in a few months or a year's time or whatever? And we explained to them, actually, the rates probably won't go too far down from where they are now. And I was trying to find a statistic. It was for a multi-unit freehold block. And I was trying to find a statistic for, say, the middle of 2021, when rates were at their almost lowest, I think, and to see how they compared to today's MUFB, multi-unit freehold block, rates. And I couldn't find anything that definitive, but the indications from headlines and everything were that they weren't actually that far down from where they are now. Maybe 0.5%, maybe 1%, but it just shows that the swap rates that the lenders are using are already factored in, and rates don't go that low. Even at the bottom, your buy-to-lets weren't that much lower than they are now. So it's an interesting question, and we are seeing little bits taken off the rates every now and again by the lenders, but they're not massive cuts, and they're not coming out and saying we're going to, in a year's time it's going to be a lot lower. Everything I've seen is we're not at the lowest and we're not at the highest, but we're not too far off where it will sort of sit, I don't think. What do you think anyway? Because obviously you're looking at the rates.
Yeah, I've not been looking that closely in the last month or so, actually, but it's interesting to hear that. I think one thing that has always stood out to me, certainly in the last 18 months, is the effect on product fees, because obviously those have had a lot more more movements, which have made a big dent, just so the actual mortgage interest can remain affordable. So that's probably a good question to ask you then. What have you been seeing in terms of the product fees then? Because that obviously gets slapped onto the onto the loan, and then how does that affect the loan to values that are being offered at the moment as well? So fees and loan to values.
Yeah, so fees can be added onto your loan by some lenders will allow you to do that. Not every lender, and some of the fees are quite toppy. West One have a fee of 9.99 and Lambay have 7%, and it has enabled transactions to proceed where otherwise they wouldn't have been able to. Also, when you add the fee, you can obviously be repaying that or repaying the interest as you're going along, so it makes it more palatable. It's been around for about a year now, probably, these high fees. As rates ease, you'd expect them to probably drop off, the large fees. But it does give people options, and in in low yielding areas, for instance, London, it does allow you to get further up the loan to value curve. So I think there's no real harm in them from an option point of view. It gives people options, and as long as you're borrowing responsibly and you're not overgearing and your portfolio's not overgeared, then I think they're not to the detriment of the industry, and I don't think as long as customers don't overgear, they should be okay. And I just want to clarify that as well. When I say overgear, a lot of people are borrowing from a senior lender, but they're also borrowing investor money as well. Yep. So that is a dangerous game in some instances, because if you've got 100% finance and things start to move, then it could cause a bit of problem.
Yeah, you've got to ensure that you're building enough equity into that product, into the project or into the deal, to make that a viable approach. Which so it can work sometimes on that basis, but I agree, if there's not enough, then that can be challenging. For sure.
Yes, definitely, and hopefully people have learned the lessons from 15 years ago, whatever it was. But probably not. So, always looking for an angle.
What have you seen in terms of the loan to value products that are being offered as well, generally across the board? So, for example, it's quite typical to go up to 75%, but you also used to see, probably like in the last 3-4 years, there were a lot of 80% products as well. I imagine probably not so many of those at the moment. But what are you seeing?
There's not so many. There's not so many, but there are some. So you can go up to 80. But saying that, I've never used one. Nobody has thought the extra interest is, is worth it for the extra 5% loan to value.
Yep.
So I've never had anybody use one or want to use one. Nobody's ever asked me for one. And I don't, when I go back to my customers, I say to them, there's the 75% product, the 65 or the 55, whatever it may be. I don't usually put in front of them the 80% product unless they ask, because one, it's more risky for them, and two, it's more expensive. So in their interest, unless they ask, I don't generally put that in front of them.
It's interesting to say that, because I have looked at some of those products before. They tend to be with very conservative lenders, though. So actually what I found was, even though they were offering an 80 or I think even Kent Reliance were offering 85% at one point a few years back.
Yeah.
Tends to be on very, very conservative valuations. So actually, if you went to another lender and got 75%, it'd probably be on a higher valuation anyway, and you end up netting the same loan amount,
Yeah.
albeit on a different valuation and at a different price potentially. But I think there's a bit of an element of marketing tactics involved there as well to make
Yeah, I
it
think
seem appealing.
Yeah, it does. It does seem appealing, and it does get spark people's attention. But really, those deals should only be, I think, used if it's really necessary. Say you've done some sort of conversion, and you need 80% at the end of it because you've been downvalued.
Yeah.
That's when I think they come into play. But then a lot of the lenders, if it's a downval, it's usually because of valuers' comments, and they often restrict the loan to value then. And I never get that, why lenders do that. They get a valuation done and they say, oh, the valuers had some negative comments, so we're restricting the loan to value. But I don't understand why they restrict the loan to value, because the value was already given the value.
Yeah, agreed.
Yeah. They do it.
We talked about it before. Yeah, it should already be factored in.
Don't understand it, but no lender has ever given me an answer as to why they do that. And maybe we'll get a guest on and see what they say.
Who can tell us a little bit more from the inside.
Yeah,
it's interesting because I guess when you're growing a business, you're probably more likely to be more highly leveraged at the beginning, because that's what enables the growth. You've got to take a little bit more risk to be able to grow. But then as your business starts stabilising, as you mature through your growth, you probably want to start deleveraging. And I'm actually at a stage now where I'm happier to have lower leverage on my assets. But I equally try and only focus on projects now where I'm building significant equity value into them, so that actually, even if I am on a lower leverage when I refinance out, that actually it's still hopefully going to have little or no money left in. It's very hard to get to that, but unless you've got an exceptional deal, sometimes it's not that achievable. But with the really good deals, then it can work well, and you don't need to be going above 70-75%. But it's got to be quite a special deal. I mean, there is one I'm working on in the background, which hopefully is going to be not far from that, but more details to follow. But that's definitely a way of de-risking also.
Yeah, I think so. I think you just have to make the most of situations and ensure that you're maximising the potential of any transaction.
Yeah.
So it's very important that you do that. But hopefully we'll see more and more activity, see more and more people who are wanting to get into property, because there are opportunities out there. So hopefully we can help them along the way.
Indeed. Are you seeing any new lenders bringing any new innovative products to the market, or even just new lenders on the scene?
Well, there's two different questions. So,
That's right.
Am I seeing new innovative products coming to the market? No, not really. Am I seeing new lenders? Yes, I'm seeing new bridging lenders who are doing exactly the same as everybody else, but pretending that they can work quicker, lend more, and it's exactly the same. But what I do find, one of the things I do find, when a new lender comes in, they say, "Oh yeah, we're going to be quicker than everybody else, but we have to charge more." And we're like, okay, but it is what it is. I did have a customer come to me, HMO conversion, this one, and we were really happy because we were actually able to provide the customer with 3 very different options. So we could go to them with a interest retained. We could go to them with a interest part retained, part rolled up, and we could go to them with an interest rolled up option. Yep. And for the people watching, the difference between all those 3 is interest retained is where the interest is taken off of the loan before the loan is actually given out. So the net day one loan is reduced. The interest part rolled, part retained, the interest is taken off of the day one loan to start with, and then on the development side of the loan, that is rolled up, so it's paid on refinance. And the third option, the fully rolled, is where it's paid fully on refinance, so it's added to the loan, and you can get more loan out of the lender than the retained option. And generally they're priced, the retained is the cheapest with the rolled most expensive. So it was really interesting giving the the customer three different options with three different prices, and they were all distinctly different options.
Yep.
Before they were could be a bit muddy, but it was really good to see that, and the customer, really not enjoyed, that's a bit of a strong word for finance, but appreciated the different options that there were for them.
Yeah, I've had something very similar recently, actually, completed on loan for a purchase, and having those options made a big difference, because it's all about, okay, what the purchase price is, i.e. the day one value that's been attributed to that asset, and then it's a question of, right, how much equity do I need to put into the deal based on that day one amount. So as you said, it does make a big difference having rolled up versus retained up front, and it depends on what you're doing with the building, lender appetite, and as you say, the more you borrow, the more expensive it can be as well. So it's that constant way up, but it's definitely good to have those options and the understanding of those options. There's some solid advice there.
Yeah, exactly. So I've got another call. I've got to be on at 12. So I think perhaps we should wrap it up for now.
Indeed, it's been a good recording. Hopefully, people have enjoyed watching and listening to this. This is the first of many. We'll have more guests. We'll love to hear your questions, so that we can have more targeted discussions moving forward. And please do listen to our podcast, Show Me the Money, Unlocking Property Finance as well, which is available on all good podcast platforms. And obviously you can hear a lot more about what we've been talking about in previous episodes with our guests, underwriters, lenders, surveyors, solicitors, etc. So plenty to learn from, and please do engage with us if you've got any questions. But yeah, it's been a pleasure. It's been good fun recording this first one, Mark.
Yes, definitely, and hopefully people will be able to look out for them in the future and get involved as well.
Look forward to it.
Great.
Amazing.
Thanks, Ray.
Cheers, everyone.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.